Just got done editing this interview. You guys are going to love it. Before I do that, though, I want you to know that I'm going to be in the comments for the next 30 minutes or so answering your questions. If there's additional questions you want me to ask the CEO next time I interview them, leave them below. Or if you're just loving the data points I get CEOs to share, click the thumbs up button below. That's your way of telling me you're loving this stuff, and I'll get you more of it. Additionally, again, I'll be in the comments answering any questions you have. All right, for 30 minutes. Enjoy the interview. Hello, everyone. My guest today is Jason Hsiao. He's the co-founder and chief video officer of Animoto, an award-winning online video maker that makes it easy for anyone to create professional marketing videos. Jason, you ready to take us to the top?
Let's do it.
So you guys have been around a while, huh? When was launch date?
We actually first launched in 2007, which sounds like ancient years ago. That was actually before, I think it was before the iPhone, or no, the iPhone just came out, but MySpace was more popular. That Facebook was still kind of up and coming. It was kind of crazy.
Jason, you're aging yourself.
I know.
All right. Tell us, for people that are not familiar with you guys, tell us what the company does.
So we are an online video maker. We basically try to make it drag and drop easy for anyone, even if you have no video experience, to make professional quality videos to market your business. So we're kind of for those of people familiar with Canva or Squarespace, we're kind of Squarespace for video or Canva for video. And
is this a tool? I mean, I used this back in the day. I don't think we paid for it. That's why we used it so much. Is it a free tool, or what's the revenue model? How do you make money?
Yeah, so we have a freemium model, but we have subscription plans kind of ranging from $100 a year to $500 a year. But we have 3 different plans, but it's free to try.
What would you say your sweet spot is? What would you say? So if you take your total customers and total revenue, would you say the average pay is what, $100 a year, or it's higher at 200?
Yeah, more like the $250 kind of range. So we kind of have our professional plan, the middle plan.
Yep.
That's
now,
kind of most popular.
Can someone pay monthly, or they have to pay kind of upfront annual?
They can pay monthly. And what's interesting about video, as opposed to I think a lot of other SaaS businesses, is video is still kind of one of those things. Even though video is everywhere, not everyone is actually convinced that they that they need to be using video all the time. And so it's very much some people have very specific needs. They need to do 1 or 2 things. Some people come back after 6 months or 12 months or 5 years or whatever. So it's a little bit all over the place. But I think more and more now we're kind of getting into that wave where people are like, oh, okay, video is actually kind of like a form of communication now. I need to start figuring out how to use this more regularly. And so the onus is on us to figure out how to make it easier and easier and kind of show people what they should be doing.
So 2007 was launch date. Walk me through how you got your first 10 customers. Do you remember?
Yeah, well, let's see, man. We were basically, a few of us actually were still working. We were working in the TV industry here in New York, and we actually kind of started this on the side. And we gave ourselves a year to see if we could actually prove out this technology. And we thought it was going to take a few months. It took us a year to even see if we could do this. And it was basically the idea of rendering original video frame for frame in the cloud. It's totally nerdy, but we were no one's done this before, so we're going to try to do this.
And who's we? How many of you are there? 3, 4?
There are 4 co-founders, right? But there are basically 3 of us that were kind of more on the product side, and I'm the least smart of the other 2 who are kind of the geniuses. And then we got to the point where okay, well, should we do this? And we're let's give ourselves a year and see if we could pull this off. So we raised basically kind of I guess what we call a family and friends round, but all our kind of friends and family in the Seattle area, we hit them up for checks of $25,000 and $50,000. And we're you probably will not see this money back, but if you love us, give us this money and, help us chase our dreams. So we gave ourselves a year, and that we basically raised enough to kind of
How much did you raise?
We raised, it was a few $100,000. It was basically just enough for us to pay rent and feed ourselves kind of minimal food and get by for a year.
But Jason, this isn't this wasn't a year when money was just flying around though. I mean, we're about to go into one of the biggest recessions in a long, long time. Did you get this money right before or right after 2008?
This was before.
Did you have people calling up going, wait, give me my money back?
Well, no, we had actually gotten that early round. Luckily we had already kind of gotten going with the family and friends round. And then, we were actually about to raise kind of our first serious round, literally the week of that, where everything kind of everything crashed and Sequoia posted their rest in peace, memo or whatever it was. And we were sitting in waiting rooms at Sequoia and other places, and then everything fell apart. So we kind of had to kind of step back and kind of figure out what we wanted to do.
Jason, let me step back though on this first year. So the first line of code was written in 2007 or 2006?
2006, and then we launched our website in 2007.
So how much cash did you guys sink into the MVP? So between your first line of code and your first dollar of revenue, do you remember?
Well, if you count kind of like the salaries and everything that we kind of give, it was probably like we probably put in a few $100,000, $300,000 in total of kind of our collective efforts and opportunity costs, something like that.
And so tell me the story of that first customer, that first money coming in. It must have felt great.
Well, we got kind of lucky somehow when we launched. Honestly, we're total product and technology nerds. We actually didn't really know who was going to use Animoto. The one thing we did right, well, we did a couple of things right, but one thing we did right, because we actually remembered from the first .com bubble and burst in the late 90s. Now I'm really aging myself. That, the big lesson learned there was you don't just create eyeballs and then tack on your business model. Like, you have to like figure out how to actually make money. So we're like, okay, well, we're actually going to, against the advice of so many people, because they're like, guys, no one pays for anything on the internet. Look at Google, look at Yahoo, look at about Netscape, and like you have to figure out how to do this for free. And we're like, no, we think that if we can do something well enough, people will pay for it. And so we kind of stuck to our guns, and it was like in the early days, it was like $3 a video or $30 for $30 a year for all you can make, and we just kind of made that up because no one else was really charging for stuff. And then we launched. We didn't really know who was going to use it. And then we got lucky. Like, I think in that first day or two, Michael Arrington, who used to be the head of
TechCrunch,
with a big following, he caught wind of us and wrote this really nice thing. Like, here's these guys who are doing one specific thing really, really well. And he just kind of became a fan and followed us for a few years. And so that exposure in the early days really kind of like set us in motion and gave us a lot of great exposure.
2007 to 2008, that first 12 months you were in business, about how many customers did you sign up? Do you remember?
Well, because we were also focused not just on businesses, but basically kind of like anyone who wanted to create video. I mean, we had thousands right away, especially if since we were charging per video, $3 a video. I mean, we had like, tens of thousands of customers in those early days. So it felt like we were successful in those early days. We're like, wow, everyone's using Animoto. And then, fast forward several years, we're like, this is actually not real success because we have no idea what we're actually doing and who we're focused on.
Yep. And by the way, that Michael Arrington article posted at 8:10 a.m. on August 26, 2008. The subtitle was "Happy Birthday, Animoto. You guys make me happy." I mean, you don't get a much stronger endorsement than that.
Yeah, for someone who's, kind of he's notorious for being pretty cynical.
Yeah.
But I think he liked that we were, doing one thing very specific and trying to do it really well. And he liked that focus. And
it's good. So your first 1,000 customers come from this kind of early traction. Fast forward today, how many customers are you serving today?
Well, like I said, over the years, we probably had, over 1 million. We have.
But how many active paying today?
We probably have like 130 active paying subscribers, and a lot of them kind of coming back. But active, I'd say right now, like, over 100,000.
Okay, about 100, I call it 130,000. And so you mentioned you've had like way more than that over your lifespan. So you're talking really to churn here, right? Which is when people use you once, how do you make them really, really sticky? At this price point, right, churn is obviously an issue, or maybe not. How have you addressed churn?
Well, what we've realized because of our type of business, we have to kind of approach it in a very kind of multi-layered type way, right? So we know that, I don't know, about 20% of folks who come in will actually just stick around, with us forever. And the rest, like I said, it just depends on where they are in their business. We have a lot of small businesses. Some of them are just getting started. So the idea of like jumping right into social media and posting all the time, it's just, they're not ready for that. They're like, I need a video for my homepage or for, a cover video for my Facebook page or something. They're just trying to get like the basics in place. But if we feel like that we can serve that need really well, that in 6 or 12 months time, when they are ready to do some more, like start doing ads on Facebook or, start promoting some of their regular product line or something like that we can kind of be there when they're ready at that next stage of the company. So we've kind of learned that we just need to kind of almost like sub-segment our businesses and really kind of understand where they are in their business maturity and their social maturity and their video maturity and kind of cater to each one of those. So I know that's kind of like a non-answer, but
I mean, there's a lot of specifics and the insight's good, but for the sake of time, I mean, if you look at the past, call it 12 months, the past year, what would you say gross revenue churn is at? Is like 20, 30% or higher, would you say?
Yeah, probably about 25%.
Okay. I mean, and you guys are happy with that? I mean, that's not horrible for this price point.
Yeah, I mean, it's always hard. You look at other companies, and I think we just have to understand the type of product we are, which is video, and it's just different from like email or some other things. And so, in some ways, we're kind of figuring things out as we go.
Do you
But
have
I
meaningful
think,
expansion revenue or like an upsell team or no?
yeah, oh yeah, we have kind of teams dedicated to like how do we upsell or win backs and all those.
So
types
do you
of campaigns.
cover that gap? So for example, the customers who signed up exactly 1 year ago, let's say 25% of their revenue will churn, but the other customers that stay, will you upsell them by more than 25%? So your net revenue retention is above 100%?
I'd say it's close, but I think where we do better is we're kind of strong in our top of the funnel. So our growth kind of comes more from top of funnel and finding new customers. I think we could actually honestly do better and kind of like the win back or retention side of things. So
interesting. Okay, so probably no meaningful expansion revenue from upselling, you don't think?
I think part of it will just come from the macro trend of people actually realizing that they need to do video more, and that's becoming kind of more cost effective than some other traditional marketing channels. So
okay, fair enough. So let's talk about top of funnel, right? So today, name a growth channel working really well for you that most people might not expect.
Well, I know this probably it actually is word of mouth, and we've tried.
Jason, that is the most boring answer you could possibly give.
I know.
Okay, if you're going to give that answer, give something to my audience where they can really understand how they could replicate how you've done word of mouth. Try and make it specific for us.
Well, I'll actually say our second biggest, because I think so word of mouth, and it's because we're a video company, so we happen to be the type of product that people share and talk about, and it's visual and it's exciting, and so people talk. But the one that we can actually control better, right? It is basically direct paid marketing, primarily on Facebook, on Instagram, on social. And using video. So the nice thing is we're actually, eating our own shit.
Dog food.
We're eating our own dog food. We're growing.
You don't want to call it shit, Jason. You want to call it, something much beautiful. Dog food, right? All right.
Is dog food?
What scale are you? I mean, are we talking like $1 million in ad spend a month across these channels, or what general scale are you at, would you say?
Oh yeah. Probably. It's probably up there, around there. And we're trying all sorts of different channels. But I think the big picture, so I guess for just folks listening, I think the biggest mental shift that we've had and that we've been trying to tell people is that I think that the impact that social media has had, I don't feel like people have maybe, especially small businesses, have really grappled, have really kind of embraced it. It's really changed everything in the sense that, like, I think traditional marketing, which is how most people do marketing still today, it's like the holy grail is getting people to your website, right? So whatever you can do to lure people, to your website. And that's kind of how marketing is done. But I think what's happening now is you don't actually have to sit around and wait for people to get to your website. You can actually take your message or your content or your information to where the conversation is already happening, and that's on social media.
So what do the economics though on that look like for you? So let's use your average price point. Let's call it $250 a year. What will you pay? Like, what's your fully weighted CAC, would you say, to get a $250 a year new account?
Well, we have a lot of different segments of users, so it kind of depends. But
we'll just use 250. Yeah, like a 250.
So on average, we'll say, we should be willing to pay up to 250 to acquire, a new customer.
Is that about where you're at though, or are you better or worse?
No, we run things pretty tight around that. So
12-month payback period, no matter the cohort.
Yeah, we kind of use a 24-month payback period. So we kind of extend it, slightly, but I'd say we're relatively conservative because we kind of found that it works. And so,
well, Jason, sorry, I don't mind cutting you off, but I want to get a bunch of stuff in before we end. How do you afford a 24-month payback period? That means the more customers you add today, the bigger your cash gap is, but they'll pay off in the future. But 24 months is a long time to wait to get paid back. How can you afford the cash gap?
Yeah, well, it took growing into, right? So we started with 12 months. And then as we felt comfortable that we were reliably, getting that cash back, we could extend to, a year and a half or two. So now we feel like that we're confident enough in this channel and we have enough cash in the bank that, for any rate that we can extend, to 24 months. And it's a dominant channel, but it's not like, it's not our only channel, right? If it was our only channel, we might be a little bit more kind of risk adverse. But
if we go macro, I know that's just one channel, but if we go macro in the entire company, what would you say like top of funnel total hits to the website is on a monthly basis?
Total hits probably in the gosh, I should know this, right? in the millions. I don't know what it is.
And
4 or 5 million hits.
How many new customers will you convert, or trials will you get from that, users?
Well, we'll get about business customers. We get probably average about 150,000 a month.
Okay, new trials. So they're trying for free. And then how many of those convert actually to paid, would you say, on average?
We have about like a 7% conversion rate.
Oh, okay, that's not bad. So that would be about 11%. So call it 11,000 convert to paid.
Yep, and those are specific business customers. And we have a bunch of non-business customers that we try to figure out what to do with also. But where we're kind of betting is on the business customer side.
Yeah, I mean, that's healthy, right? If you get 11,000 new customers at an average price point of $250 a year, you're basically adding almost $3 million in new ARR every month. That's a good growth rate. Did I get that right?
We like it. Yep, we like it.
Yeah, that's good.
But we have challenges on the churn side, retention side, and we got to get people using video more regularly. So that's I think
what's your team size today, Jason? How many folks?
We're about 100 folks, mostly in New York. We have a handful of folks in San Francisco, and then some other folks all over the world.
How many engineers?
We're pretty heavy on the engineering side. We're probably over half, probably 2/3 of our company is kind of on the product development side, which is mostly engineers. So we're definitely heavy on the development side.
And do you have any quota carrying sales reps at this price point, or is it too cheap for that?
Too cheap for that. We've kind of entertained the idea, but I think it's we need to rely more on kind of cheaper channels.
Yeah. Now, you mentioned covering a 48-month or 24-month kind of cash gap. Have you raised like gobs and gobs of money? How much have you raised to date?
Officially we've done 3 rounds. So that initial family and friends round. Then we did a kind of a Series B with a VC, Madrona, and a few other folks tacked on, including Amazon. And then we did a Series C with a private equity group, Spectrum. So we've raised, just over like 20 million or something like that.
Okay. Well, the Spectrum one was 25 and the Madrona one was 4.4, right? So about 30 million total.
Yep, about 30 million. You've done your research.
Oh yeah, of course. But I want to let you say it. I don't want to steal your thunder. So now maybe the reason you said it was 20 million, not 30, is because 10 of that was maybe secondary. Spectrum does that a lot. Did some of this go to secondary?
Yeah, some of this went to secondary.
There we go.
Yeah.
There's nothing wrong with that, by the way. A lot of founders think the only way to get liquidity and early employees is to sell the company. But no, you can negotiate a nice kind of secondary as well. Yep.
That's kind of a newer thing I found out. But but it's nice because we want to swing for the fences, but at the same time, we want to take care of things at home. So
yeah. So just to be clear, the 25 million from Spectrum, some portion of that, maybe call it 5-10 million, did go to early shareholders, early employees, and founders.
Yes. So that's why I kind of say what we technically raise, is probably in the 20s, total.
That's fair. Now that last round of Spectrum was back in 2011. A lot of people would say, wow, you haven't raised in 7 years. And once you're on the venture track, if you're not raising every other year, something's wrong. How'd you respond?
Well, we've been pretty lucky. Like pretty much from day one, we've run basically a cash flow, call it neutral business. So we've always been making money. And so really our periods of raising money is just to kind of try to take advantage of some spurts of growth, right? But we've always run a cash flow positive. So actually we're in a great, spot.
Jason, can I ask how significant that is? Are we talking like 30% EBITDA margin every year, or 50 or 10 or?
Well, we run, I guess basically we run a cash flow neutral business, right?
Okay,
so everything we make, we basically put right back in Animoto. So technically it's like we could probably hit 30-40% if we want it, but we're reinvesting everything right now.
Yeah. Now, can I do this math? Tell me if this is accurate. You said earlier about 130,000 paying customers, $250 a year. If I can just multiply those together to get about 2.6 a month, or about, you guys have crossed a 30 million run rate at this point. Is that accurate?
Yeah, we're in the ballpark.
Okay. And if you're in that ballpark now, call it 2.6 million a month today, where were we at exactly a year ago? Do you remember?
Just shy of that.
So you've been about flat. You've been about flat year over year.
I think. Well, no. We've been growing. I don't know exactly what we were last year, but we've been.
What do you know? What you grew at year over year? Was it like 40%, 100%, 10%?
No, we're kind of in the double digits right now. We're kind of like in the double digits right now.
Okay, so somewhere between 10. That's a big range. Between 10 and 100%. That's double digits, right?
10 and 99.
10 and 99.
No, we're probably like in the 20% growth rate right
okay.
now. Yeah.
You say that almost in a shy fashion, but you should be proud of that, right? Considering what you've raised relative to your ARR. Why are you shy about that?
Well, I don't know. I think maybe that's good for the stage that we're at. I feel like we're always being compared to, or I always compare myself to everyone else, and I'm like, oh, I always feel like we should be going much faster. But maybe
no, but you have incredible leverage, right? When you compare the amount you've raised relative to your ARR, right? So you really only put 20 million on the balance sheet, 10 of the 30 was secondary, right? Your ARR is more than what you've raised. That's a beautiful place to be in, and you're cash flow positive. That's a great story. You should celebrate.
Yeah, I know. And so, but sometimes we're like, are we being too conservative? Should we be, like swinging even harder? So I think we're always kind of like wanting more. So yeah, I guess we do have a lot to be proud of, but I think we can do more.
It's one of the reasons. It's one of the reasons I wanted you guys on is because you've had history, you have scale, you haven't raised a ton. So no, this is exciting. Now, what is the next big metric? Do you guys think you'll break 30 million in ARR by the end of this year, or what's the next big target?
Yeah, I think it is. We would like to kind of keep. I think a big push for us is just focusing a lot more on mobile and international, and I think those will unlock a lot more opportunity. But certainly all those milestones, 40, 50, 100.
Is there any? Is there any? Is 50 a stretch goal for next year, or do you think you need like 2021 to get past that? How realistic is that?
Probably a couple years, maybe a year and a half.
Yeah.
17 months, 18 months.
Yeah. Now, are you in talks right now? You've driven a nice scale since 2011. Are you in talks right now to do any, call it $100 million secondary or any big secondary raise?
No, we're always thinking about it because we're always like, well, what would we actually do with that money? And in some ways, right, it's raising money comes at a cost, right? It's giving up some portion of the company and changing up the board dynamic. And we actually really love our board dynamic right now. We have fantastic partners from Madrona and Spectrum. So
what is it, a five person board?
It's a 6-person board. We can have 2 independents, 2 from the financial institution.
Jason, 6-person board. You're never supposed to have even board members. You're going to end in a 3-3 tie. That never happens.
So far, knock on wood, it hasn't, because we seem to be pretty aligned on things.
That's good.
But we're always entertaining those conversations, and so kind of have our fingers in many different kind of chats.
Well, Jason, so another hypothetical. Canva obviously has a lot of cash to work with, considering the valuation, what they've raised. If they're looking to drive nice growth, they could come after a firm like you. Let's say they offer 10x your MR or 10x your ARR. Let's say $300 million. Do you guys take a $300 million deal?
Sure, we're always open to conversations. But I think for us, it's whatever we can do kind of fuel our vision. Like we genuinely love video and see how exciting it is to empower businesses. So whatever partnerships or opportunities we can take to kind of help fuel what we're doing, we're open to discussing.
But are you in any acquisition talks right now or no?
I'll just say we've always been in various chats with things.
Folks, that is a yes. The body language is saying yes.
We've always been in chats with things. But I personally, I know that things change, on the flip side of those type of things. And I kind of love what we're doing right now. And so in many ways, I just want to keep doing what we're doing.
On that note, Jason, let's wrap up with the famous 5. Number 1, favorite business book.
I love Radical Candor. That's probably my newest favorite.
Number 2, is there a CEO you're following or studying?
I love Brian Halligan from HubSpot. He's just a super inspiring guy.
Number 3, how many hours of sleep do you get every night?
I would like to get 8. I probably get 6.
Okay. And
I have baggy eyes.
No, you don't. What's your situation? Married, single, kids?
Married, and I have 2 twin girls who are 7, which is why I don't get sleep.
Oh, wow. Okay. So married, 2 kiddos. And I meant to ask you, what's your favorite online tool for building your company besides your own?
Oh man. I was probably the last person to use it in our company, but I actually have grown to really love Slack.
Okay, good. And how old are you?
I am 43, I think, plus or minus.
That's good. You can't remember. That's a good thing, right? All right. Last question. Take us home. What do you wish your 20-year-old self knew?
Wow. I wish, I think the biggest kind of bullshit kind of strategy advice we've been given and what a lot of people tout is just try a lot of things and see what sticks. And I just realized, man, especially for any kind of early stage startup, time and resources is limited. And you don't have time to just try a lot of things. That's what strategy is. So be smarter about making choices and having strong rationale for those choices.
Guys, Animoto, they help businesses make videos more effectively and quicker. About 130,000 customers paying, call it $250 per year. So call it flirting with a $30 million run rate right now, up from just 2.1 million a year ago. So about 20% year over year growth as they look to continue to scale. They've done this in a very capital efficient way. 30 million raised today, about a 10 million of that went to secondary. So 20 million of the balance sheet. They're profitable, which I love. 100 people, 66 engineers, no quota carrying sales reps. Obviously at this price point, 25% revenue churn annually, no meaningful expansion attention yet as they look to figure out that churn issue. About $500 to get a new customer for a 2-year payback period. Jason, thank you for taking us to the top.
Thank you, Nathan, and congrats on the success of everything.
These CEOs rarely give these kinds of interviews. I hit them hard, I get the data, and I want to do it more. So if you want to get more of this stuff, make sure you subscribe up here. And then additionally, go check out one of my other CEO interviews right now.